Okay. Let me start by welcoming you all and of course presenting to you DueDash and what we're doing. So first again, great to have you all for our today's edition of the DueDash Investor Lounge, of course, where we bring you exciting investors, share interesting developments, and of course, want to make sure that both as a startup and investor, you can learn something new, have interesting discussions, and educate here. But before we do, of course, I want to briefly introduce to you who we are, what is DueDash, and why are we doing this in the first place. My name is Michael. I'm one of the co-founders and CMO of DueDash. And let me start by sharing why are we doing this in the first place. The VC industry is going through difficult times. You might have noticed it is difficult for investors to really ensure who are the right startups to back, engaging with them, because there's often a lack of proper data insights. At the same time, startups wonder, what am I doing wrong? How is my investor engagement not working out? What do I have to do differently? And that's where we came in to say, how do we change the biggest problem in the venture capital industry? That lack of dynamic, proper data insights, but also the data asymmetry that often exists between both sides. With DueDash, we do that. It's one investor relations platform that streamlines the entire communication and data exchange between both the founders and the investors. At the same time, it cuts down really the time and cost by 50%, and thus enabling qualitative, successful investor relations. And we have been doing this for some time. By now already, we have a sizable number of users on the platform, help many investors, startups streamline and bring more efficiency to that process, and happy to help you guys as well. For that, you can join under DueDash.com to get started if you're not on DueDash yet. To add, we are supported by a lot of amazing partners, might it be deal providers, incubators, accelerators, VC funds, and other further partners. If you're interested in these, you can write me a quick message. We also have information on our partners on our website. If you're interested to learn more about DueDash, if you are looking to further engage, whether it be investor reporting you want to do to your investors, you might want to do better due diligence, you're trying to engage with investors, or at the same time, investor side, you want to bring more efficiency to your current exchanges, might it be in due diligence, might it be again on reporting, portfolio management, happy to have a chat. You can scan these QR codes. I'm also going to share links for both the startups and the investors in the chat once I'm finished here. And of course, we're looking forward to hearing from you and engaging further. Now, before I give it to Parul, one little request I would have to all of you. Ask questions. We want to, of course, make this engaging. So when you have questions later to Tahira, to Parul, put them into the chat. We'll get back to these later in the session. If you already have them now, put them in. If they come in later, put them at that time. And we're looking forward to hearing from you. And now, let me hand it over to you, Parul. Just let me also pin you so that also both of you are visible. And then I'm going to take myself out of that. And up to you, Parul.
Thank you, Michael. For those of you who don't know me, I'm the founder and CEO of DueDash. As a serial entrepreneur, I have built multi-million-dollar companies in the past and also invested privately in many startups for more than 15 years. I have experience in M&A and basically the whole shebang. And I'm really excited today to welcome our guest, Tahira Jasani from Resilience VC. What a name. It's amazing. She is managing partner and co-founder. Resilience is an early stage VC fund based in Washington, D.C. Their focus is on embedded FinTech, investing in scalable companies, driving returns, and some amazing portfolio companies that they have. She focuses on investing and supporting FinTech and non-financial services business that embed payments, credit, insurance, and saving offerings to drive financial resilience for consumers and small businesses. Tahira is also an adjunct professor at Johns Hopkins and Georgetown University. And it's my pleasure to have you today here, Tahira. I would like you to take us a little bit back in time and share a little bit about your journey, how you realized investing in startup was an important thing, that you chose that to be your career, and what role does your background play in your current venture?
Thank you so much, Pearl. It's great to be here and to get to chat with you and everyone else here. In terms of my background, I started my career in management consulting. I was at Bain for a few years, but decided to move off of the traditional consultant career path because I wanted to start to build some operating experience. I wanted the experience of, launching products, managing a P&L, et cetera. So I moved into the operating space in the telecom industry. And within the telecom industry, and this was the early 2000s, one of the products I worked to get off the ground was a mobile wallet, a mobile payment solution. And this was in Afghanistan. So, the second country in the world after Kenya to launch mobile money, and really the first digital financial solution that existed in that market. And by building that infrastructure and those payment rails, we started to enable significant digital financial transactions. And Afghanistan at that time was 97% unbanked. So almost none of the population had a bank account. Most people did have a cell phone. And that's really what got me interested in this intersection of technology and financial services. And my career since then has been focused on FinTech, either as an operator or as an investor. And for the last 15 years or so, I've been investing in FinTech. And the reason that I moved onto the investing side from the operations side was that I wanted to help build not just or launch one product or build one business, but support the growth of multiple businesses in this space. But I am very much at my heart an operator and a builder, which is why I invest at the early stage. Coming in at the seed stage, working with founders that are building out products, that are getting things off the ground, and helping them think through the key challenges they're facing and help them get ready for scale is it's great. It's the best part of my job. So
Awesome. I love that. And I didn't realize we have a common denominator here, telcos, because I work with Ericsson, if you remember, I mentioned.
yeah.
And then before getting onto the operator experience, the telecom has been my heart, soul, and everything. So I'd love to hear about that. So, yeah, in the current market landscape where resilience and sustainable business models are paramount, assessing startups is becoming more and more crucial. At DueDash, we follow a 5T model with an emphasis on team, timing, technology, traction, and TAM. I'm actually curious about your perspective as an investor and what specific characteristics do you prioritize when you evaluate founding teams, like, factors that contribute to a founder's success. And because it's fintech, and it kind of is a bit different, I guess, from any other tech space, and what kind of founders succeed, that don't succeed, what constitutes to an ideal founding team and the profile, and also considering the adage that past performance does not really guarantee future success. So what kind of a criteria or evidence do you consider as really important when you analyze a company at an early stage when you come in?
Yeah, that's a great question. And especially investing at the early stage, there's so much on the business model that is still work in progress. And so more than anything, you are taking a bet on a founder at that stage. And, at Resilience, we believe that finding founder market fit is really important. And it's critical for me that a founder really know and understand the customer need and the customer experience. And so whether that comes from lived experience of being in that customer's shoes, or whether it comes from having spent a lot of time and energy really building relationships and getting to know that customer segment, that's something that I really look for. Additionally, the founder investor relationship is an important one. And here in the US, the average founder and VC investor relationship lasts longer than the average marriage, which unfortunately says a lot about the state of marriage in this country. But, I think I say that to say that it is a meaningful, long-lasting relationship. And just like we don't typically get married after the first date, we aren't investors who will put money down or a term sheet down after a first call. We take time, we do diligence, and a big part of that diligence is really getting to know and building a relationship with a founder. And that comes with time, right? It comes from getting to see someone not just in the context of them pitching to you and telling you exactly what they think you want to hear, but it comes from seeing them over time in different moments, in good situations and bad, interacting with their team in a you know, in with partners, when things are hard, when things are not. And so a big part of assessing a founder is just getting to know them, really getting a sense of values alignment as well.
Yeah, I think that's a very important piece that you share there, sharing the good, the bad, the ugly with the investors, because you're getting into a long-term relationship here, leading up to 5 to even 7 or maybe 10 years. It could be anything.
Yeah, exactly.
So yeah, that's a very important piece. You say that. So we all talk about AI today, so I had to bring it up. So given the significant disruption that AI is creating, and in fintech, particularly with taking the large volumes of data for analysis, improving the security, and also perhaps transforming customer service experience there, what specific business models do you find most compelling, or conversely, which ones you would like to avoid? And how do you assess the niche focus and innovation quotient within these models today?
Yeah. So AI certainly has the possibility to be really transformative in fintech. And most of the companies that we evaluate and invest in are incorporating AI in some way. I think today AI is not ready to be fully customer facing with financial products. There still needs to be some maturity in the technology, I believe. But that's going to continue to evolve rapidly. And so, we are going to see AI integrated more and more. However, when it comes to AI, just like any other technology, what I often see is founders that are saying, here is a technology, here is a solution, let me go find a problem to solve, right? And applying AI in contexts where it may not be the best option. It may not result in the optimal customer experience. And so what I think is critical with AI, as with anything else, is that, again, we start from that customer-centric view. What are the needs of the customer? What needs to be solved? Pearl, when you were talking about those 5 T's, you talked about the TAM, the market, right? Let's understand exactly what the market need and opportunity is. Let's understand what the customer experience should be, and then let's figure out what technology is best suited to deliver on that. And that's how I think AI needs to be considered, right? And AI has value on the back end. It will, over time, I think, have increasing value on the front end as well. But the use of technology, AI or otherwise, has to be grounded in a customer need and a customer experience.
I agree. So, I mean, fintech sector, so to speak, has seen phenomenal growth over the last decade, and going on to your experience, 20 years, right? Coming on to a couple of decades if fintech started back in the day, but not as much. And with the recent emergence of a lot of trends, I can call them disruptive to some extent, like crypto, real-time payments, generative AI, blockchain. How do you foresee navigating opportunities, investment opportunities in your case, for maximum impact and success? And the recent statistics indicate that neobanks and the shift towards digital financial services. How do you prioritize key criteria during startup, analysis, identifying promising investment prospects?
Yeah, it's a really good question, and I'm glad you mentioned neobanks, right? Because the we've seen when we think about the evolution of financial services delivery, we really historically financial services were delivered through brick and mortar physical bank locations, right? Over the last 15 years, we saw the rise of the first wave of FinTech, which is really the digitization of previously analog financial services. And we saw the unbundling of what banks were offering, and then the rebundling of what banks were offering into the neobank model. And we've seen neobanks sign up lots of customers, but we haven't seen a lot of neobanks really be profitable. And there's certainly some exceptions to that, right? New banks, and there's a couple of others, but of the almost 80 neobanks in the US market, none have reached profitability. And so absolutely, there is a shift towards digital financial services. Absolutely, customers want an easier, more digitized user experience when it comes to managing their money. At the same time, what happens with neobanks is that many customers will sign up for and open a neobank account. But what they won't do is switch their direct deposit over. They won't get their salary payment into that new account because there is a cost, right? There's a switching cost. They have to go to an HR department, get a new form, file paperwork, get the account number, the routing number. It takes time. And those friction points actually mean that despite the fact that most customers will tell you that they don't like their traditional bank, very few will actually switch away from it. And so, when you're looking at, say, a neobank model, it's very easy to say, oh, look, good growth in users, there's a lot of value here. But you have to look beyond that. You have to say, it's not just about who is signed up as a customer, who's an active customer, who's using this account on a regular basis, who has transferred their direct deposit and salary payment into it so that money's coming into the account so that transaction fees can be generated on spend from the account, right? And so I think that the neobank example really highlights a couple of things. One, the need for, as you're doing that data analysis as part of diligence, of really digging more deeply. It's not just signups and acquisition costs and customer growth, but it's active users, it is transaction volume, it is looking at customer engagement in a very specific way that is actually going to help investors identify where the real opportunities for growth and returns are.
I'd like to expand slightly more on this, if that's okay,
Yeah.
because I think we're going to see potentially more consolidation with what we've seen last year in the banking sector. And also, I was reading an article because I was going to talk to you today. So interestingly, while millennials loved neobanks, Gen Z, 33% of the Gen Z who, out of the ones who opened the account, 33% of them actually like to go to the bank, actually physically, and they would like to speak to someone versus having a complete digital experience. And the other aspect of the whole thing is the evolving landscape where, we've had, First Republic, being folding into JP Morgan, and the flows, collectively getting, showing all the flows of the capital getting into the bigger banks. So the trust is still kind of underlying your point, which you mentioned, the trust is still with the bigger banks. So how do you see this dynamic shift happening with all the changes that are happening, whether it is bank deposit outflow or the investor interest in early stage startup? How do you see this the mess getting sorted out before it will probably have a different direction? This industry will have a different direction.
Yeah, I mean, look, there's There's always challenges in the market, and certainly we're in a moment of more volatility and more challenge. But generally, we have seen the best venture vintages come out of, the times of coming right after the times of economic challenge. And those economic challenges do mean real challenges on the consumer side, right? Consumer debt, for example, is at an all-time high. More people today are financially vulnerable than they have ever been. And so we are in a moment where, one, there is more of a need than ever to build financial resilience for the end user, because people's financial lives are precarious. 70% of Americans are financially unhealthy. They are living paycheck to paycheck. They are spending more than they are earning. They have inadequate protection against risk. They don't have sufficient long-term savings for retirement, right? And that's a challenge not just in the US, but all over the world. And the fact that more and more people, even younger folks, even folks who are higher income, are still struggling and living paycheck to paycheck, are still not in a good financial place, creates massive opportunity. Because if we can find companies that are addressing those customer needs, that are actually creating more financial resilience for the end user, having them generate more net income, right? Which is either increasing their earnings or decreasing their expenses, helping them better mitigate or better recover from shocks and risks, and helping them build assets over time. Those are the models that are going to succeed, because there's a massive customer need. This isn't a niche market opportunity. This is the vast majority of people in the world today. And building financial resilience is a returns multiplier. A customer that is more financially resilient is a better customer. They're going to have larger balances, bigger transaction sizes. They're more likely to repay a loan. They are going to have generally more usage and better loyalty and retention on your platform. And so building financial resilience for the end user is a returns multiplier. It is what will drive growth. And so in the current market, we see real opportunity on the consumer side, and then also more broadly on the market side. There's this is a great time to be investing. I wouldn't want to put money into the market at the peak of it, but right now there's real opportunity to come in, to take time to really evaluate businesses, to be more valuation conscious. And I don't just mean price sensitive. I mean ensuring that valuation is aligned with traction and performance.
Sure. I think it's very, very insightful what you just shared, because a lot of businesses kind of are shifting towards lending model. But if general population is not healthy, so those business models potentially are not sustainable as well, to some extent, I would say. So how do you foresee sourcing deals and conducting due diligence evolving amidst the tight-knit VC networks and the prevalent practices of investing within familiar circles, especially in the light of increasing globalization of investments? How do you go about sourcing your deals, and what's your view on, co-investing and investing together with similar set of people?
This is one where I have some pretty strong views. So, there's a lot of venture investors that say, we only want founders to come to us through warm introductions. We want someone that's been vetted by our network. And I certainly see some value in that. But that means that those funds are only seeing founders and businesses that are within their networks. And to your point, Parul, we're seeing innovation being globalized. We're seeing more opportunities that are coming up outside, a 30-mile radius around Silicon Valley, right? We're seeing many new venture hubs around the world. We're seeing founders that are more diverse and that come from more non-traditional backgrounds arise. And so focusing only on sourcing your deals within these tight-knit networks and communities, I think is short-sighted. It may make it a little bit easier to get comfortable with a founder initially, but in the long term, it will prevent investors from seeing the best of what's out there. And so at Resilience VC, we're incredibly intentional about sourcing in a way that really widens the top of the funnel as much as possible. We, on our website, have an open submission form that any founder can fill in, attach their deck, and it feeds directly into our pipeline CRM. And we review those deals every week and we'll respond to every founder that submits there. That's really critical to us. It's important that we aren't just gate-kept, that you don't have to be in our tight-knit network or know someone that we know to be able to get your company in front of us. We really think it's critical to be as inclusive as possible initially. Now, does that mean more work? Yes, it does. But I think it also means that we are going to see more companies and better companies and ultimately make better bets and drive better returns. And the data shows that homogeneity at the investor level is damaging to returns. The more homogeneous partners are at a venture firm, the less well they'll perform. Diverse teams outperform, and that's at the founder level and at the funder level. So if we truly want to see a more diverse set of entrepreneurs and support a more, the vast majority of venture capitalists are white men. The vast majority of founders who get capital are white men in this market. And so if we want to change where the money goes, we have to change how we're seeing those opportunities and who controls the money.
Yeah, I think two of us are definitely driving that change. So kudos to you. Yeah, I mean, you touched upon a point earlier on. So in the light of the imperative, startups are urged to emphasize on value over valuation. And they must navigate the current environment by employing strategies, by focusing on burn rate, prioritizing cash flows over growth, and obviously have tamed expectations. How do you perceive the recent shifts within the venture capital industry per se? And do you anticipate any significant alterations in VC practices? Or do you see that the current status quo will continue as it is, the way it is right now?
So, certainly money is not flowing as freely as it was a few years ago. And my view is that that's good for the industry. It forces founders to certainly make trade-offs, but ultimately really focus on making decisions that are going to drive value for the business, right? Not saying, hey, we'll just get users now and worry about monetization later, etc. Those practices are no longer going to fly, and that's good. I think it means we'll see better businesses getting built, and the businesses that aren't going to survive are going to die more quickly. And that's not a bad thing. Venture funds certainly need to be thoughtful, though, about the fact that money isn't flowing as freely as it was. And so when we're investing, I think we have to be really thoughtful about capitalizing rounds and founders at the right level. I don't think it makes sense to have someone raise a seed round that gives them 9 to 12 months of runway. That's simply not enough time to hit the milestones that they're going to need to hit to raise that next round, right? We're encouraging founders to raise seed rounds for 24 months of runway, given the uncertainty in this market. We are working with companies that we look at and that we invest in to be really focused, hyper-focused on the metrics that matter, right? And it's not just user growth, but it's active user growth. And it's not just active user growth, it's active user growth thinking about revenue. We have to think about ARPU, average revenue per user, as we think about users, right? We have to think about ways that we can optimize our acquisition and acquisition costs. It's no longer just, hey, I can throw money at this problem and buy customers very easily. Companies that rely just on digital marketing spend to drive users are in a race to the bottom, because those users are going to get more and more expensive to acquire as competition heats up. And that's really challenging. So we focus specifically on embedded FinTech models rather than full stack models, because we think that the ability to embed or integrate into other products, services, channels, or value chains drives huge advantages from a distribution, data, delivery, and trust perspective, which is going to result in lower acquisition costs, better user experience, higher usage and retention, and ultimately more value. So I do think that practices are going to start to shift, but it takes time. It won't happen overnight.
Makes sense. It's really very interesting what you just shared. So with the emphasis on resilience during market reset and the recognition that enduring ventures are built through challenges and difficult times, and you already mentioned the role of communication between startups and investors is very important right from the first meeting onwards, if you really want to get that seat at the table before you actually receive the check. Do you believe that sharing continuous reports with investors, even during challenging times, contributes to building stronger partnerships and navigating crisis much more effectively?
Yeah, I mean, look, I think as investors, the more information we have, the better we can support our companies, right? And so getting regular reporting, but also the right reporting and high quality reporting is really critical. So, one of the things that we do is work closely with founders to say, what are the metrics that you need to be sharing, that you need to be tracking, first of all? Are you capturing the right information? And once we align on that, then yes, we want to see that on a regular basis. Often with early stage companies, we're checking in on a monthly basis, if not more frequently. And so having access to the data to inform those conversations is critical. And that can come in many forms, but certainly the more real time and the more automated that is, the easier it is for both the founders and the investors.
Absolutely. So on DueDash, startup founders can create their company profile. They get a structured data room where they can share their one-pager pitch deck. And if it is a good fit, then they can build investor engagement, and they can share their monthly, quarterly, whatever the cadence they decide on investor updates right from the platform, and investors receive that in their inbox. But if they sign up, they kind of see that within the product as well. And it's a complete ecosystem for investor relations in single system, and investors can use it as for all aspects of deal flow, due diligence, and portfolio management. So all of you can set up your free profile right away if you haven't, and investors can also access deal flows for all the companies that are already registered there. So moving on, considering the persistent uncertainty, and we've seen a few cycles out there. We've seen that it takes about 4 to 5 years to come out of that. So it's an evolving landscape in the fintech industry, and we touched upon the factors like consolidation and payment infrastructure and customer retention. What's your outlook for this year, 2024, and perhaps for the subsequent 4 to 5 years? What do you see would be, some interesting companies that would be coming up?
Yeah. So, overall, as I mentioned earlier, I'm quite bullish on the opportunity right now. And that's because, customer need is massive right now. For consumers, for small businesses, there is a need for high quality, relevant, and affordable products to support that. And that's at the infrastructure layer, as well as when it comes to direct to consumer or B2B2C models. All of those are really critical to help people and businesses be more financially resilient. You mentioned customer retention, Parl, and that's one that I would love to touch on a little bit more deeply for a second. Acquiring customers is expensive and will continue to be. And even when you are getting distribution advantages through embedded channels and things like that, it is typically going to be cheaper to retain a customer than acquire a new one. And yet, so many startups in the early stages focus much more on acquisition than retention. So that is something that I think we are going to really see a shift towards is, a real focus on how do we get value from our existing customers? How do we retain them? How do we create better product roadmaps, better graduation pathways, ultimately a better experience for them over time? Because especially when it comes to financial services, customers can be very sticky if they get ingrained enough into the product. So that's one that I think startups really need to focus on and will do more and more of over the next few years. And then I think, I mentioned our focus on embedded FinTech, and that's something else I really want to emphasize as I look forward and look out at the next few years. Most people don't want financial services for the sake of having financial services, right? I don't want a loan so that I can go and say, hey, I've got a loan. I want a mortgage so I can buy a house. I want a student loan so I can go to university. I want insurance so that I can access healthcare. The financial tool is the enabler. It's what allows us to utilize some core product or service that we find value from. And so the more that we can embed or integrate that financial enabler into that core offering, I think the more we will see value and the more that users will see value, because then financial services aren't something that are separated out from the rest of their lives and their experiences. It is truly integrated into everything that they do. And I think that that means not only the best user experience, but ultimately the best way to drive value for the user and to generate value from the user.
So very well put together answer. Thank you. So I'm going to ask you a few quick questions, okay, that you could answer in a couple of sentences. Let me know when you're ready.
Absolutely, go for it.
So a great 1-minute introduction that should contain certain elements when somebody talks to an investor like yourselves. Could you just give an example or just explain what those elements should look like?
Yeah, I mean, we hear talk about that 60-second elevator pitch from founders, and I think, look, it's not a lot of time. You're not going to be able to tell me everything about your product and your traction. So I would say this is, my personal bias is use those first 60 seconds for me to get to know you. And if I feel like you are someone that is interesting, is values aligned, then I want to learn more about what you're doing. And you'll go from that 1 minute to me giving you then a 30-minute call or meeting, and we'll go from there. If you throw thousands of words at me in 1 minute, going into deep detail about your product, it's not going to be very productive. So give me a chance to get to know who you are and why you're working on the problem that you're working on. And then we can spend more time talking about the solution.
Awesome. So I was going to ask you about the latest trends and technology that you're watching and feel strongly about, but you've mentioned embedded finance you feel very strongly about and you're focused on that. Is there anything else you'd like to add to that?
Yeah, one thing I'll say is that there's always going to be new tech and there's always going to be new trends. And I think that they can be really powerful enablers. But what I am focused on most is products level innovation, is innovation in distribution, is, and use the technology, use a trend, use something as a way to better enable that. I am less interested in, hearing the buzzwords on AI, Gen AI and crypto and Web3, et cetera, et cetera, et cetera, in your pitch. I want to know why those are the best solution in this case, why those enable you to do something that either no one else has been able to do or at a price point that no one else has been able to deliver.
Very interesting. Okay, which sectors or industries do you think will struggle?
I don't think any sector or industry is going to be immune to, the effects of broader macro trends. I think overall we're going to see more and more consolidation. Farley, you talked a little bit about that earlier, and I think that's right. I think that we're going to see that across the board. And the sectors and the industries that are going to do best are the ones that are going to be hyper focused on that customer experience.
Awesome. So I'd like to have your take on climate finance and ESG data reporting.
Sure, let's take those one at a time because look, I don't love talking about climate as a category or climate change as a category, because I don't think it means a lot to most people. I think most people care about the implications of it, and we should think about framing it that way, right? Someone can say, I don't support investing for climate change, but it's very hard to find someone who says, I'm against clean water and clean air, right? If we can frame the climate issues as issues that matter to people, I think we're going to see a lot more traction. One example is I'm looking at a company right now that is looking at making heat pumps more affordable as opposed to traditional HVAC systems at the residential level. Now, a heat pump is better for the climate, right? But it's also on an ongoing basis cheaper for the homeowner, and more, and because it's more energy efficient, there's a lower cost. There are going to be some people who say, I want a heat pump because it's more climate efficient, more climate friendly. But most people are going to say, I want it because it gets me the heating or cooling I need at a cheaper monthly price. And so where climate finance becomes really interesting to me is how can we get technologies that are climate friendly, but also create better experiences for the user, particularly when it comes to affordability, and decrease that upfront cost. Because a heat pump can be more expensive upfront than a traditional HVAC system, but on an ongoing basis, it's much cheaper. And there's actually, government subsidies, tax credits, and rebates to make that upfront cost lower, but accessing those can still be challenging. And even with a rebate, you have to pay full sticker price up front, and then you get that money back. So if we can finance against that, right, that's where I think there's real opportunity, because it's not saying I'm investing in climate for the sake of climate. It's saying, again, coming back to this idea of user experience. What are the customer's needs? What do they want here? Framing the climate issue in that way, I think, is what's going to be most powerful. On the ESG question, again, ESG is a topic that's fraught and there's a lot of viewpoints on it. For me, ESG as a category even doesn't make sense because there's so much that's lumped in there. Putting governance into the same bucket as environmental impacts that a company has doesn't make a lot of sense. Do I think good governance is absolutely critical? 100%, right? And we have seen FTX was a great example of what happens when good governance isn't in place. I think we're at a moment in the market where people are not going to accept poor governance and oversight anymore. We need boards to be constituted early, to be effective, to provide strong oversight of these businesses. Good governance is critical. My view is, and as an investor that focuses on creating impact and sees impact as being in lockstep with financial returns, I do think the S part is really critical as well. Having social impact, making your customers, in my case, more resilient, creates long-term value for the business. So I see, and similarly on the environmental side, as we just talked about with the climate finance piece, I think each of those components are valuable, but they're valuable because they make businesses stronger and they create value for customers.
Awesome. So any idea you think should be worked upon and no one has tackled yet?
There's a lot of those. But, I would say there's a lot of industries and, for example, in the US, health insurance is one of them where you've got policy in place that makes it hard for startups to be incredibly disruptive in this space because you have large incumbents. And I do think that the businesses, the founders that are able to figure out how to disrupt these types of industries are going to do very well. It's challenging. It's not easy. These are incumbents that have been in place for a long time, have strong lobbying power, and a lot of regulatory support. But these are also spaces that are so ripe for disruption.
Who is your childhood inspiration?
For me, it wasn't one single person. It was the idea. I was a big reader as a child, and I continue to be today. And this idea of, there are so many worlds out there, and these worlds that are created through narrative and story, where so much is possible, right? There's so many things that can be done, can be achieved. And I read every genre there was. I mean, from, sci-fi to biography to whatever it was. But that through language, you can construct a world. And in these worlds, anything can be possible was something that I loved. And I think that idea still very much underlies a lot of the investing work I do today.
So what are you currently reading?
I am currently reading a book called The Future. And it kind of posits a world. It's a theme of power, but what posits what happens in a world where power operates differently than it does today.
What qualities do you value most in a professional relationship?
Trust. Yeah. And were you going to say what drives that trust?
Nothing. No. Please
No. So I think for me, and when I think about the primary professional relationships for me are with founders and with other investors. And ultimately, that trust, especially with founders, is so critical. I have to be able to believe that you are being open and honest, and that you will continue to be open and honest, whether things go well or poorly. And the founder investor dynamic is an interesting one, right? Because there is a power dynamic where the startup is trying to get money from the investor. There is an incentive to say what you need to say to bring that money in. And initially you're pitching, you're selling, and then you're negotiating. You're on opposite sides of a table, negotiating a term sheet, negotiating a deal. And then as soon as that deal is signed, you're on the same side of the table. So this relationship goes through these phases that isn't necessarily the most conducive to building trust, because of the power dynamic because of the fact that you're on opposing sides of the table initially before you move on to the same side. And founders that can be really open, that can engage investors, that can be receptive to feedback while still having clarity and conviction in their path. I think those are the ones that I really, really am excited to back.
What drives you when you get up in the morning?
Depends on the day. Sometimes it's the need for caffeine, but no, for me, I'm a morning gym person, and so getting to the gym early in the morning, being able to have that time that is about me, is about kind of focusing on my exercise, my body, and being healthy, clearing my mind, and then getting ready for the workday is a good mix.
Awesome. So we also have people who invest as angel investors, and some of them who would like to get on the path in the audience. So those of them who are contemplating investing or have just begun their journey, what would you like to say to them?
Be really clear on why you want to invest and what your thesis is. There's a lot of people I talk to who say, oh, well, I want to get into venture. Well, why? What's your view on the world that's differentiated that will let you find companies and make bets that others won't? And if you can't answer that, you probably shouldn't be doing this. So have real clarity of purpose around it, and that will feed into clarity of thesis. Why are you investing? Who are you trying to get capital to that is undercapitalized today? And what will make them take your money as opposed to someone else's? And, that thesis can be around things like stage and check size and geography, but it can also be about market trends and opportunities and technologies that you see. And really, that's where I think it gets most interesting.
Awesome. So we'll pick up some more audience questions. I try to embed them in between. How exactly I think they're looking for certain service types. I think you did answer that earlier, but let me just pick up this question. How exactly or by which service might the FinTech strengthen the financial resilience of its customers?
Yeah. Lots of different ways, right? But we think about financial resilience, as I mentioned, around 3 key dimensions: net income, asset building, and risk mitigation. And ultimately, I would say that if, as a startup, you can find a way for someone to increase someone's earnings, decrease their expenses, improve their ability to weather shock and risk, and help them build their asset base, you are strengthening financial resilience. So the question is, how do you do that in an effective and responsible way that drives value for the user and for the provider, right? And that's where the challenge is. But I'll give you an example from my portfolio. We've invested in a company called Alice, and Alice helps workers better get the value of pre-tax benefits on a contribution-free and real-time basis. So what it does is, by enabling certain actions like commuting with public transportation, et cetera, that can be tax beneficial for the customer, by automating the reporting and the access around those, they enable the average worker to earn an extra week of wages a year by getting the tax benefits of that spend. That's a direct increase in net income, right? And that's meaningful for a worker, for a family. We believe that's something that strengthens that financial resilience. Does that answer the question?
I guess, yeah, it's a good answer. So there's another question seeking your views on fintech market in Africa. I know Resilience invests predominantly in US, but if you have any views that you could share for Africa and other growing emerging markets.
Look, I think the customer need that I talked about is not specific to the US context. And prior to launching Resilience, I was investing globally. So, know the African market well. And what I would say is that I think there's still massive opportunity. In the US, almost everyone has a bank account and access to, most people have access to credit, things like that, right? In emerging markets, depending on the market, there is more of an access opportunity than there may be in markets that are more established, or markets like India, where there is, India Stack and a strong government push to bring that infrastructure into place. But the access question, certainly in Africa, is a real one. Once you get beyond that access question, though, it's about how is someone using this product to add value to their lives. And that's ultimately a question of resilience. Specifically, look, over the last couple of years, we have seen less capital flow to Africa. We have seen, especially Western investors, being more risk averse when it comes to emerging markets generally. I think that that's starting to shift back. We're starting to see larger rounds and more capital flowing back onto the continent, which is really exciting. And we're seeing that money not just go to, South Africa, Kenya, and Nigeria. We're seeing more money in Francophone West Africa. We're seeing more money in North Africa. We're seeing other parts of the continent really get better capitalized than they have been.
I can definitely agree to that. There's a lot of focus on Africa right now, and so many funds, on the ground, actually, American funds, including European funds, have been there, but more and more American funds are also on the ground right now. So definitely.
Certainly, and I think that point, Parul, is really important. You can't sit in Silicon Valley and say, I'm going to invest in Africa. You do need to get on the ground. And that comes back to this point that I think I've made a few times about being customer centric. If you don't understand the needs of the customer in that market, if you haven't spent time on the ground there, you aren't going to be able to make effective investments. And so both founders and investors really need to understand the customer bases that they're targeting. And when it comes to investing in emerging markets, it means having a presence on the ground.
Couple of more questions. What struggles
Carl,
are you seeing?
Do have to
yeah.
jump. I know we're past time.
Yeah. All right. So I'll take one last question, Tahira, then. I know we just passed a couple of minutes. So if there was an advice that you had to give to young Tahira, what advice would that be?
That's a good one. Let's see. It's interesting. I launched my own venture fund. That was never something that I expected to do. And I ultimately did it because I didn't see anyone else doing it the way I thought it should be done. And I looked, and I worked for a lot of different funds. And that's true when it comes to both, investment thesis, when it comes to who's in charge, when it comes to the integration of impact into the thesis. And it's true when it comes to how you engage with and support and interact with founders. On all of those levels, I didn't see someone doing it the way that I thought it needed to be done. But it took me a long time to say, well, that means that I have to go build it. And so I would tell myself to be willing to do that sooner.
Nice. Well, it's been fun talking to you. I know you're there on the DueDash platform, and you'll find some amazing startups. Some of them might even hit you up there. I'm looking forward to your engagement there. And thank you so much for sharing the time with us today. And listeners, everybody, thank you so much for joining us from wherever in different parts of the world that you are. And if you liked it, please share it on different socials where we'll be posting. And I did receive a question on DueDash data. So the data is in the control of founders. They will decide who they share the data with the investors, and all the investors that we have little over 2,000 investors on the platform. They are all vetted investors. We have a team of analysts who actually painstakingly go through the profiles and even talk to them before they approve their subscription on the platform, and likewise for startups as well. So please feel free to reach out to our team. Michael is on here, I am here, and a bunch of other people who you could reach out to through the website. So thank you, Tahira, so much for your time today. I wish you a great day ahead, and we'll stay in touch.
Thank you so much, Parul, Michael, and everyone. It was great to meet all of you.